So the stock started to pull back a little bit today, and nothing earth-shattering, right? And there's a near-term volatility starting to pick in. We're starting to get smaller up moves, starting to get a little bit bigger downward moves, starting to get shorter timing between highs and lows on a near-term basis. So it doesn't mean that we're tanking. It just means that we're running out of gas. This bullish intermediate run's running out of gas. The trend is still there, so our trade idea will take advantage of that. There's sector leadership that's rotating in the favor today, at least. We'll take advantage of that. And then I also break down the technicals in the short term, how they relate to the longer term, especially as we head into the new year. There's a few things I tweeted out that I'll share that will guide us in our expectations for the next 12 months. So that being said, let's go ahead and get started. My name is David Settle. This is my market outlook for today. What is today? Tuesday, December the 19th, 2017. Thank you very much for watching tonight. Welcome to those that found me that are watching for the first time. Keep coming back for more. Subscribe to my YouTube channel by clicking that red subscribe button right down there below the video. You can do it while you're watching. Also, hit that thumbs up icon that's right next to it. That lets me know that you liked it, that you want me to do it again tomorrow. One click easy way to give me some feedback there. Scroll down further and comment on anything that stands out to you from today's video, anything that you learned, any new things or old things that you're reminded of. In the description, there's a bunch of links there. Subscribe to my daily email newsletter by clicking that first link. That's where I'll send out emails every day with summaries of what we're talking about in these videos, time-stamped, hyperlinked summaries, as well as the clusters in the S&P 500 today. All bullish clusters, all oversold clusters today. Follow me on Twitter for more content in addition to these videos I put out throughout the day. My handle's up on the screen there at DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. Join the Market Outlook Facebook community with the addresses up here, I believe. There's a link there again. If you're not a Twitter person but you're on Facebook, I'll put the same stuff out there in the Facebook group that I'm putting on Twitter. And you'll be able to interact with others that are watching these videos every night too, and kind of see what everybody's learning there. Alright, well, let's take a look at the S&P 500 with the market forecast indicator, see what's going on here, and you can see another drop today, and again, near-term volatility is going to increase. We still have an upward trend. We're still getting near-term highs, near-term lows, higher highs and higher lows on the near-term line, and I'm looking at these ovals that correspond to peaks in the blue line and lows in the blue line. So, you know, we are getting some near-term volatility. It doesn't mean that we're tanking, right? It doesn't mean that the market's gonna now stall forever, right? We're just gonna get some more ups and downs. I mean, when I say near-term volatility, I mean more ups and downs. We're not gonna get these kind of longer, extended 7 to 12 day runs that we would expect when we're kind of in the beginning stages of an intermediate run. When you're in the latter stages of an intermediate run, you start getting shorter ups and downs and more frequent ups and downs. That's what I mean when I say near-term volatility. So we got a engulfing pattern on the S&P 500. The momentum line again spiked down to extreme lows, so below the 5th percentile, again suggesting that possibility of a posture change from what is now strongly bullish to a weak, what would be a weak bearish. Because remember, you never go strong bullish to strong bearish. It always goes from strong bullish to weak bearish first. Then it goes from weak bearish and gathers strength into a strong bearish trend. Of course, and then when it goes from strong bearish, it will change to a weak bullish. Never from strong to strong. Always strong to weak and weak to strong. So keep that, never weak to weak for that matter either. So so that's what we got right now. So we've got two of these. In fact, two extreme lows in the momentum line since the intermediate line got back in the reversal zone. So again, more near-term volatility. You notice we don't get a lot of these lows at such extreme low points when we're strongly bullish. We did here. That prompted a little bit of a pullback, but even that wasn't that big of a deal, right? And so now we're starting to get a lot more of them at these extreme levels. You can kind of see you start to pick them up when the posture changes, to more of a bearish move. So don't be surprised if the intermediate line turns weakly bearish. I mean, that's what these are telling you to expect, and that wouldn't be that bad of a deal, because remember, we can pull back to 23% Fibonacci level based on these divergences, especially on that stochastics divergence, and not skip a beat. You know, that would not be a big deal, and and probably wouldn't even get the intermediate line down below 50. And if we were to come down to 2600, which would just be a 38% retracement, as bad as that would seem, that might actually will get the intermediate line below 50, but it would be a much higher intermediate low point and be an obvious and easy buying opportunity if and when that occurred, and probably would help get that market sentiment line back down to the 60-70 level, which has been the launching point for the last couple of intermediate runs. One wasn't very long, but the other one, obviously fueled by the tax cut bill expectations, has been a 4-monther. So that's like 2 4-monthers in the last, the last month was in the last 52 weeks, but in the last 2 months. But we've had 2 of these big, strong, long intermediate runs, longer than normal in the past year. So it's been a good year. If you take a look at the Dow Jones Industrial Average, it's almost exactly the same. It doesn't have the it does not have the momentum line dropping, but it does have the possibility of a divergence, lower highs with obviously higher highs on the index itself. So keep that in mind. Where could we, obviously there's also this stochastics, that divergence that would put that low point similar to what we see in the S&P 500, but again would not be, that kind of a pullback would not be earth-shattering in the least bit. NASDAQ also pulling down, not quite so extremely low as the Dow Jones was. Bigger gap to fill in that didn't quite fill in all the way. Still has a strong bullish posture. Again, just expect shorter near-term rallies than what we typically get when you're at the beginning of a bullish move, than when we're at the end of a bullish move. And of course, the Russell 2000, take a look at that one here, with a bigger loss in all of them today, also did not get, because the gains were so big the prior 2 days. This small move looks big by itself, but in context of the prior 2 days gains, not as big, and so that's why the momentum line didn't drop as low. And only got to 12.5, so and still shows a bullish posture. So again, we're getting more signs of a pullback, of a near-term pullback coming on. But again, nothing. It's like right now in Utah, where the forecasts are for some snow over I think by the end of the week we'll get some snow, like Thursday, Friday kind of a deal. But small, like not very much, nothing that would suggest. By Christmas the snow should be gone, unless it's just too cold for it to melt. The snow should be gone, and so again, it's like forecast for snow, and it's like, oh, hunker down, and and it's gonna be great. But the reality is, it's only a little bit of snow, and it's gonna be gone just like that. We're gonna be back to sunny. Unfortunately, that's the kind of weather we're in this year. We're just not getting a whole lot of snow. And we're getting cold temperatures and sunny conditions, but that's what we're getting right now in the markets. We're getting sunny conditions. Yeah, there's a forecast for some rain right now, but it's not going to be that big of a deal. It's going to be gone before we know it, and the long-term trend most likely will remain intact, barring any significant change from a global geopolitical event risk that the market obviously has not priced in yet. Small range so far in the long-term chart. Again, everybody's anticipating this vote that went through the House today. Looks like it might have to go through the House again tomorrow before the Senate votes on it again. But that's expected to pass. There isn't any expectations that this thing won't pass. It looks like, based on the market response today, that as it does pass, don't be surprised if we don't start to pull back towards that 50-day moving average, especially considering from a technical perspective how far above the 50-day moving average we are. Again, you look at price here compared to the 50-day moving average. I did this yesterday with the 200, but you can see the same thing exists with the 50-day. We're just well up above that. And when we get this far up above it, it slows down. Our gains slow down until it catches up. You can see even here, it didn't necessarily slow down. There's a 2-week drop, but it wasn't that big of a deal. And that's something I expect, something similar, to that, or even worst case scenario, something like this, when we were also this far above the moving average, like we had in March. And again, remember, this was the 4-month rally, intermediate run that led into this kind of a move. So, and that last push, here's that fourth month. It's a very similar pattern we see then, the end of last year, beginning after the election, to what we're seeing right now. From a 3 green arrow standpoint, you can see that nice engulfing pattern up there, but we're still well up above the 8-day moving average. The MACD is still the highest it's been since this area back here when we were 20 points off. Just for some context, if I go back even further on the MACD, go back a couple years, but stay on the daily chart, you can kind of see that, yes, we're high for where we've been this year, but you know, when we had that late February surge, that fourth month of this intermediate trend, you know, we were higher, and you can see coming off the election, we were also higher on the MACD, and you can see there's a couple times last year, excuse me, in 16 last year, that we also had MACDs very high, coming off of the low point when we got below the 200-day moving average at the beginning of the year, as well as in the middle of the year when we pushed off the Brexit move, when we pushed off of that strongly up to new highs. But with this chart, you can also see that divergence pattern on the stochastics, starting to cross below its moving average again. Higher highs already, and the low point in between would be right there to 26.25. Again, happens to be the 23.6% Fibonacci level. That will also happen to be where the 30-day moving average will most likely be around by the time we get to that point. So again, as we pull back from these lofty levels, we have an idea of where we're going to pull back to before we find some support. So the engulfing pattern you can see on SPY, you can see it even bigger engulfing here because of the bigger gap we had. When you take a look at that engulfing pattern, you can see we started up with a small gap to the upside today, up to above 263.5, so up to yesterday's high point, afternoon high point there, and then we dropped throughout the day. We dropped to yesterday's low point. We started to fill in the gap, and we pretty much came down. We pretty much filled in the gap to Friday's high. So most of that weekend gap. We didn't quite fill it in all the way, but you can see we came right down to last week's high. High of the day was as early as the day, pretty much right when it opened, and we pretty much closed at the low point. So that's a pretty bearish candle. But keep in mind, again, there was a pretty decent range, less than 1.5 points. The volume down to 78 million. So 1.5 points is below this line. 8 million is also below this line. So the small, that's not a bad, that's not a bad pullback. It could have been worse if we had been, 90 million with almost a 2-point range. That's more bearish actually. If it was more extreme, then we would have bought it immediately, similar to what we saw here. When you get the big drops from all-time highs, like this one, for example, you get a big old drop with a huge range and a lot of volume from all-time highs, buy it, that's almost you buy it immediately. So we're not getting that, but we're also not getting, it would have been more bearish if the volume was up in this level and the trading range is up in this level. So the fact that they're both below those lines is a positive, positive for the market. It's a boring pullback, but that's okay. Boring pullbacks mean that the trend's still intact and there's no threat yet to that long-term trend. Yeah, there might be a little bit of a pause and more of a sideways action if we get something like this, but that wasn't a threat to the long-term trend. And if we were to replicate that now, obviously it wouldn't be a threat either. So if we take a look at volatility, it's rising. We expect it to rise. We expect it to have a 4 or 5 point range this expiration cycle. Most of that's going to come from here. It's not going to come from down there, based on past precedent. So we expect it to rise at some point. It's still kind of coiling too. The more it coils, you'll get that bounce at some point. But again, as you get it, every time it spiked in the past, it just comes right back down to these low levels, and that's what you expect until you see something different. Finally, here's on the absolute basis, again, you can see how there's still potential for this to rally, because while we did jump up to 80%, 80.2%, 80% is extremely low. So, we're still right at that extreme low point. There's still possibility for room. There's still room up here for this to rally and still, provide a near-term pullback on stocks. But not be significantly bearish, right? Because you'll still get a lot of support. The neutral areas between 90 and 95%, the sweet spot for bullish trends in this 85% area. So you can see, you know, all these other pullbacks have been okay. You know, they've gotten up above on an intraday basis, but by the time the day closes, volatility is in a nice, good bullish range compared to VXV, the VIXs. And so that's, again, what I expect to see again until we see something different. That's the expectations again. All right, now let's transition to what's driving this action. And a reminder again to follow me on Twitter. There's my Twitter. There's the address to get there. Twitter.com/DavidSettle42. You can find me there. You'll see a follow button right over here in the top right. Just click on that follow button. Make sure you're also liking and retweeting this market outlook tweet that I always have pinned to the top. The more you like and retweet my stuff, the more Twitter's algorithms will keep pushing you all of my tweets. And you can see there's a few things I put out there today. One of those is this divergence, very interesting things, especially in terms of like expectations for 2018. FedEx trade that we put on back in October or November 29th. So a little bit of a follow-up on that one there. But this one I want to talk about was this divergence that you're seeing from ACWI. So this is a breadth pattern. So there's, as ACWI keeps going up and up and up, there's fewer and fewer countries within that index that are leading it higher. And you can see, you know, that since September, U.S. stocks have been really outpacing. Well, in fact, here, let's go back a little bit further. U.S. stocks have been outpacing international stocks. International stocks have had a great year, but since about I guess it'd be right there. From that time, there's U.S. stock market up 7%. Small cap stocks about the same. But there's your international stocks. EEM is actually down. The market's up 7%. EEM is down. And developed markets up only 2%. So some pretty decent outperformance over the last few months. And you're seeing that coinciding with what I shared with you on Twitter there. Right there with that breadth divergence. With more of these, some weakness, especially in those emerging markets. Now keep in mind, emerging markets have had a really good run. I mean, just on an absolute basis, that's the run that they've had in 2017. So yeah, we're down below the 50-day moving average. We're pulling back a little bit, but man, that's a good run for, you know, and really the run started in the middle of 2016. A little bit of a pullback after the golden cross, right? The 50-day crossing above the 200. Pulled back to support at 34, and then it rallied again. Well, if you take a look at it on compared to SPY, so relative to the S&P 500, you can see again, decent run for most of this year until this mid-September range, or this end of August, but especially in this mid-September range, right about there, we've really started to pull back. And ACWI especially, which is an all-country world index, is what ACWI stands for, and right there, that mid-September area is when it peaked relative to the S&P 500, and look at its underperformance. So a lot of you know, some money moving back into this U.S. Market. So we'll go back to the 10-day moving out, just today's chart here. You can see again, crude oil did well, held up, had some gains. It's been lagging behind. It had a big of a pullback. It's been jumping back up over so many days. Drop middle of the day yesterday, but rallying off of that drop and back up to those highs that we had early yesterday. So energy doing well. Gold holding up some gains with a little bit of weakness in the dollar. But look at that, treasury bills just getting hammered, with TNX making a pretty decent breakout move today. If you take a look at it on the daily chart, and that's the highest close in yields that we've had since we dropped in March. So kind of a breakout move in yields, coming off of this failed head and shoulders pattern that we were looking at back here. Never did break down to the downside. Kind of held that support, up and down volatility, and then whammo. Today's a big strong move to the upside. So obviously that's going to have an impact in sector rotation. We'll take a look at that. So that's kind of your big stories today. Weakness in international stocks, and mainly just weakness because we've had so much strength all year long, and a lot of focus on the U.S. markets right now with that fiscal accommodation coming through, and then also a sell the news event. Even with all the you know, you can see the strong economic data we continue to get. Housing starts came out today, a better than expected number, better than what we saw last month. Very, very high levels of housing sales. You can see that's reflected in a very, very high economic surprise index that we haven't seen since post Operation Twist, when we were coming up off the credit downgrade. And then again, you can see the impact on GDP estimates of 3.3%. So very strong GDP estimates here coming in for this next quarter. So, and that's having an impact on rate hike expectations as they continue to rise for March. For another rate hike in March, now up over 60%, with the a second rate hike by June, pulling back just a little bit. But don't be surprised if this starts to rally. I mean, obviously higher than no rate hike at all, and you're at 30 some odd percent odds of a second one. So there's pretty decent odds, that we'll get a second hike by June. You won't see that get higher, the gray line, until the red line in March gets up to that 80% level. If that red line gets up to 80%, so pretty much pricing in the inevitability of a rate hike in March, then you'll see that gray line start to jump up to that 60% level for June. And then we'll know, okay, we're going to get 2 because of this. I mean, it's going to be kind of hard to justify not raising rates when you have all this accommodation coming at a time when the market's just roaring. 3% growth rate, for the last couple of quarters, including this one now, expected to be, and all these economic indicators starting to translate into actual strength and actual indicators, not just sentiment surveys, but actual indicators. Not surprising to see this jump in yields impact utilities and real estate negatively. What's interesting, though, is the financial sector also dropped, even though yields rallied so much and broke out, which you would think would help the financial sector. It didn't. In fact, financials were down 1.25% as a whole. Part of the reason for that, and here's the 10-year yield compared to the 90-day T-bill, which obviously is going to be a lot more closely tied to Fed rate hike expectations. And you can see, yeah, the 10-year note jumped up, but it didn't jump up significantly against the 90-day T-bill, right? So the yield spread on this one in particular still is about as flat as it's been since 2016. Of course, as this drops, that doesn't help financials. Financials like it when this rallies, and so that's one of the biggest reasons why financials struggle today, is because, yeah, 10-year yield jumped up. That's great. The 90-day T-bill jumped up too, right? And so it's been rallying significantly, and again, that's the one that's tied to rate hike expectations. So we'd like to see economic growth expectations jumping higher, and bringing that yield curve up, but not really the case. The yield curve continues to be flattening, not inverted, but flattening. It's not a bad thing when it's flattening, it just happens to be a bad thing for the financial sector, which has been like hoping for this steep yield curve for years, and it looked like we're finally going to get some, and then just like that evaporates as the Fed raises rates, but the economy is not really growing strong enough yet to get a steeper yield curve. All right, so for our trade idea of the day, one of the stocks kind of in that consumer staples area happens to be Walmart. So Walmart just killed it here with that breakout move on earnings. And you see the gap has held for support, but so far the high end too has held for resistance. We got through it on the intraday basis today, but then closed back down and closed below it, but still got decent. Here we go. Still got close to 3 green arrows. You can see the MACD had pulled down. It's close across. The stochastics already has crossed up above and given you a green arrow there. We're riding that 8-day moving average and still going up. So, I mean, there's still, still some bullish possibility here. I don't want to be too aggressively bullish, though, as you know me, unless we're at the beginning stages of an intermediate runs when I'm more aggressively bullish. And so that being the case, we got some obvious support here around this 95, 96 plus area. So what we can do is just drop it down to a high probability trade, right? So we sell the 97 put. You can see if I sell that 97 put, it's got about 35 delta with 30 days left. So you can go further out. The problem is if I go to this weeklies, the spreads are bigger. because there's not as much liquidity as there is in the regular expiration months. And this one, if I go out to the February regular expiration there, again, wider spreads and a lot more time. So I'm gonna end up sacrificing a little bit of credit here by going only 31 days out, but still it's enough time to get enough of a return. Again, if I sell that 97 puts, a mid-30s delta, buy the 94, so I'm gonna go $3 wide to spread out my risk. So what it looks like here is, pretty decent high probability trade, decent credit. It's almost a 30% return on risk, right about there. And you notice again, my break even is 96.34, so it's down. There's my break even on this chart. You can see we got above the Bollinger Band, which is a positive sign. There's my break even, and of course that point, that crossover point's below that break even. So if we get down to that point, then we know, okay, it's pulled back through that support and now starting to fill in that gap. I'll go ahead and take that $60 loss according to the green number, because the green number is going to be my loss at expiration. But you notice that's about the loss too. It will be no matter what time. So as I move it, if I were to get there today, I would lose 70 bucks, and I'm trying to get about 70 bucks. That's if I got there today. That's what the purple line is. The purple line will change as I move this date here, and you notice as I move that date, it's still about the same. You see how I'm getting about, but at that point, I'm still getting about a $70 loss. So it's roughly the same there. That's why I say that's the point that we're going to use to say, okay, if we get down there, no matter what day it is, I know what my loss is going to be roughly. So I'll take that, and that's about a 1-to-1. That's how I know I've got a decent enough credit. So if I got a 1-to-1 reward to risk at that point ratio, then I'll take that loss, knowing that I've got support in this area and I've got room to work with, and I've got a bullish, we got bullish move. We got a breakout of Bollinger Band. We got potentially 3 green arrows and good, strong move higher. I just don't want to be aggressively bullish because, again, we're in the latter stages of an intermediate run, and this stock has been on a really good run itself. It just happens to be trying to break out above this $100 level. And if it does, then we've got a good high probability trade to make, to take advantage of. And if it doesn't, if it just kind of hangs around here in this area, so let's bring up to like a hourly chart here. If it continues to hang around here in this area, then I'm fine. Because, again, we sold the 97 and my break even's a little bit below that. So that said, to summarize, the market remains obviously very strongly bullish, but near-term volatility is starting to creep in. Not necessarily that we're tanking in the near term, that we're getting more ups and downs. That the near-term bullish runs that are in the direction of the prevailing trend are getting shorter, and there's more of them. And so that means that's what near-term volatility is. And so we're pulling back a little bit. Again, any kind of pullback right now, there's nothing that would suggest that any pullback we get right now will be long-term trend changing. In fact, it will actually be a much, much better thing for us. Doesn't mean we can't make any trades. As we saw with our trade idea, there's a bullish opportunity we'll take advantage of. We'll just dial back the risk, look for good technicals that support it, know when and how to get out in case of a support break, and position size smaller than what we normally do. All that's taken into account the risks of this late bullish stage that we're in right now, but we're not handcuffed and frozen, not able to do anything because of fear of risk of a pullback. Right, a pullback would actually be a really, really good thing that we'll eventually take advantage of later. So as always, thank you very much for watching tonight. Remember to subscribe, like, and comment on the YouTube video down below. Also follow me on Twitter if you haven't already for more content I put out there throughout the day. I also am now going to start putting the same stuff in that Facebook community group. If you are a Facebook person, not a Twitter person, join that Facebook community, and I'll put that content out there as well. So as always, have a great evening, everybody. We're getting closer and closer to the holidays. For those that are traveling this week, travel safely. We'll see you guys all tomorrow.